Hey everyone, and welcome back. Every massive success story has a beginning, right? And sometimes that beginning is surprisingly humble. Today, we're going to talk about the origin of the world's biggest financial market. And believe it or not, it's a story that starts not in some fancy skyscraper, but under a single tree.
So let's just dive right in. I mean, it sounds like something out of a myth, doesn't it? But the story of how a small group of people under a tree launched a global financial giant, it's absolutely real. And, like so many great innovations, it all started because of a crisis.
To really get how brilliant their solution was, we first have to understand the problem they were dealing with. So picture this. It's the late 18th century in New York City, and the securities market is in absolute chaos, total mayhem.
Now, this wasn't just a bad day on the market. We're talking about a complete, full-blown panic. Public trust had just evaporated. People were terrified to invest their money, and the whole fragile system was right on the edge of a total collapse. So what caused all this chaos? Well, you can pretty much trace it back to one man, a speculator named William Dewar. His secret, shady dealings, and, well, his eventual failure triggered a massive wave of panic selling. He basically became Wall Street's first notorious insider trader.
So, out of all this panic and distrust, a small group decided they had to take matters into their own hands. But they didn't meet in some fancy boardroom. Nope, they met in a place that's almost impossible to even picture on Wall Street today.
Just 24 people, a small group of stockbrokers and merchants. That's it. That was the entire group that got together and decided, you know what? We're going to be the ones to bring order and trust back to this market.
And they did it with this, the Buttonwood Agreement. It was this foundational document, beautifully simple, and it was named for their favorite outdoor meeting spot, a buttonwood tree that stood right outside of 68 Wall Street.
And the solution was just brilliantly simple. The agreement really boiled down to two core ideas. First, we promise to only do business with each other, people in this circle of trust. And second, let's agree on a fair commission so we don't try to undercut each other. It was this basic framework of trust that would become the foundation for something, well, something enormous.
But that simple promise didn't stay under a tree for very long. As the group grew, it had to evolve. And pretty quickly, it needed a roof over its head and, you guessed it, a more formal set of rules. This timeline really shows you just how fast things moved. In 1792, they signed the agreement. Just 1 year later, they're already moving indoors to the Tontine Coffee House. By 1817, it's a formal organization, the New York Stock and Exchange Board, and by 1863, it's officially the New York Stock Exchange. What started as this informal club became a real, structured institution in just a few decades.
So what was the catalyst? What took this growing exchange and just supercharged it into a global powerhouse? You might be surprised. It wasn't a time of peace and prosperity. It was actually one of the most turbulent times in American history. The U.S. Civil War. It created this huge, unprecedented need for capital to fund the war. To finance it, the government issued massive amounts of war bonds. And this just caused the number of things you could trade to explode. It grew by tenfold. This forced the exchange to innovate, and innovate fast, just to handle the sheer volume of trades.
All that incredible growth in trading volume, it required a huge leap forward in technology. The old system, getting together for these slow, twice-a-day auctions, just wasn't going to cut it anymore. So they moved to the continuous trading system that we recognize today, making the market way faster, more efficient, and ultimately a lot more stable for everyone involved.
So after all that evolution and all that growth, let's connect the past to the present. What did that simple two-sentence agreement signed under a buttonwood tree ultimately become? Today, the total market cap of companies listed on the New York Stock Exchange is over $25 trillion. It is by a huge margin the largest stock exchange in the world.
And just think, it all started with just a handful of securities, a couple of banks, a few insurance companies, and some government war bonds. The contrast between that humble little list and today's $25 trillion market, it just perfectly captures the incredible power of trust and organization.
The key takeaway here is just so powerful. Those 24 brokers, they weren't trying to build some global institution. They were just trying to solve an immediate problem of trust. By creating this small circle of reliability in a sea of chaos, they laid the foundation for the world's financial engine. It really makes you wonder, doesn't it? What small agreement you make today, what little circle of trust you build, could grow into something world-changing 200 years from now? Let me know what you think in the comments.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome to the Violet Vault. I want you to picture something. Imagine a huge, crowded room, just a sea of people shouting, waving their hands, with paper flying everywhere. For pretty much all of history, that's what the stock market looked like. A loud, messy, and very human place. Okay, now picture the exact opposite. Absolute silence. Just the quiet hum of servers in a dark room. That's the stock market today, a global network of computers moving billions of dollars faster than a blink of an eye. So, how on earth did we get from that human chaos to the silent, lightning-fast code that runs Wall Street now? Well, that's exactly the story we're going to unravel together today. All right, here's our roadmap. First, we're going to step back in time onto one of those old-school trading floors to really get a feel for the world we left behind. Then, we'll watch as technology completely changes the game. We'll dive deep into the crazy world of high-frequency trading, where speed is the only thing that matters. And finally, we'll look at the good, the bad, and the ugly of this new cyborg market and what it all means for you and me. So let's start by rewinding the clock. I want you to forget about Wi-Fi, forget about servers, forget about online brokers. The stock market wasn't some abstract thing in the cloud. It was a real, physical place, a room they often called the pit, where every single trade happened face-to-face. And this right here gets to the heart of what a market truly is. It doesn't matter if you're buying a car or a share of Apple stock. It's always a negotiation, a little battle. Buyers want to pay as little as possible, and sellers want to get as much as possible. The whole point of an exchange is just to be the referee in that battle and find the one price where both sides can agree and shake hands. And for a long, long time, this battle was fought with something called open outcry. If you've ever seen a movie about Wall Street, you know what this looks like. It seems like total, utter chaos, right? But it was actually a secret language, a whole system of shouts and hand signals. If your palms were facing out, you were selling. If they were facing in, you were buying. Every little gesture meant something, and it all had to happen in a split second. And right in the middle of this organized storm, there was one person who ran the whole show. That person was called the specialist. Think of them as part auctioneer, part referee. Their main job was to stand there and literally match up all the buyers with all the sellers for a specific stock. But here's the crucial part. They also provided liquidity. Now that's just a financy term for making sure there's always someone to trade with. If a ton of people suddenly wanted to sell and there were no buyers, the specialist had to step in and buy the stock with their own money to keep the market from crashing. They were the human safety net. So how did a trader in the pit tell the specialist what to do? Well, they had two basic commands. The first is a market order. That's basically yelling, "Get me into this stock right now, I'll take whatever the current price is." It's all about speed. The other kind is a limit order. This one says, "Hey, I'm only willing to buy this stock if the price drops to, say, $50 or less." That one is all about getting the price you want. And this trade-off, speed versus price, it's the key to understanding everything that comes next. Okay, so you might be wondering, why would the specialist take on all that risk of being the human safety net? How did they get paid? The answer is something called the bid-ask spread. It's that tiny little gap between the highest price a buyer is willing to pay, that's the bid, and the lowest price a seller is willing to accept, that's the ask. The specialist made their money living in that tiny gap, making a fraction of a cent on every share traded. It's basically the small price we all pay for being able to buy or sell a stock whenever we want. Now, this entire world, with all its hand signals, its traditions, this whole human system, it was about to get run over by a freight train it never saw coming, technology. The chaos of the trading floor was about to be replaced by the quiet, perfect logic of computer code. And the whole revolution started with this one idea, the Electronic Communication Network, or ECN. The first one popped up way back in 1969, and the concept behind it was simple, but at the time, absolutely radical. It was just, what if we built a computer that could match all the buy and sell orders automatically? What if we didn't need the human specialist in the middle at all? And this is the invention that made the specialist obsolete. It's the digital order book. Just look at it. It's like turning on the lights in a dark room. For the first time, everyone could see a perfectly organized, real-time list of every single buy and sell order in the market. A computer could look at this and instantly match the best bid with the best ask. Suddenly, the human in the middle wasn't just slow, they were completely unnecessary. And believe me, this change didn't just happen in New York. It was a massive global wave that just couldn't be stopped. London went electronic in 86, then Bombay in 95, Toronto in 97. The New York Stock Exchange, the symbol of the old way of doing things, they held out the longest. But by 2007, even they couldn't fight it anymore. The age of the machines was here. So if these new electronic networks are the new trading floors, then algorithmic trading is the new kind of trader. Instead of a person clicking buy or sell, you have a computer program that does it automatically, based on a strategy someone coded into it. It's all about using the incredible speed of computers to make thousands of decisions that no human brain could possibly keep up with. And once you can trade automatically, the game changes. It becomes an arms race for speed. If you can trade in milliseconds, why not microseconds or nanoseconds? This race led to the most extreme, most powerful, and most controversial force in the market today, high-frequency trading. You can think of high-frequency trading, or HFT, as algorithmic trading that's been supercharged. We are talking about computer programs that buy and sell stocks in millions of a second. They might hold a stock for less time than it takes you to blink. It's not just faster trading, it's a completely different kind of beast altogether. And if you're thinking, okay, that sounds intense, but it's probably just some small corner of the market, I want you to look at this number, 73%. At its peak, a small number of these HFT firms were responsible for almost 3/4 of all the stock trading in the US. Let that sink in for a second. This isn't just part of the market anymore. For all practical purposes, it is the market. So what's their secret sauce? Well, first, they have incredibly smart algorithms that can spot tiny price differences that exist for just a microsecond. Second, they basically cheat physics with something called co-location. They pay the stock exchanges millions of dollars to put their computer servers in the exact same room as the exchange's servers. This shaves a few nanoseconds off their reaction time, which is an eternity in their world. They also place and then cancel millions of orders without ever intending to trade, just to kind of ping the market and see where other traders are hiding. So we did it. We built this incredibly fast, super efficient market that runs on code. But what's it actually like to live in this new world? Well, it turns out that when you hand the keys over to the algorithms, you get some very serious and, frankly, some very scary unintended consequences. And that brings us to maybe the most terrifying thing these algorithms have created, the flash crash. This is a moment when the market just vanishes. The prices go into a complete free fall as thousands of algorithms all try to run for the exit at the same time, creating a terrifying feedback loop. And then, just as mysteriously as it began, it snaps back to normal, leaving everyone completely baffled about what just happened. The most famous example of this happened on May 6, 2010. In just a few minutes, the stock market had a digital heart attack. It plunged, losing almost $1 trillion of value. $1 trillion! And then, minutes later, it all came back. An investigation later found that one big sell order from a single algorithm basically spooked thousands of other HFT algorithms who all pulled their bids at the exact same second, causing the entire market to just disappear. So the big question is all this technology a good thing or a bad thing? And honestly, the answer is yes, it's both. The supporters will tell you that all this high-speed competition has actually been great for regular investors like us. It's made trading cheaper by shrinking those bid-ask spreads we talked about. But the dark side is pretty serious. It's created a two-tiered system, the ultra-fast and everyone else. It makes the market more fragile. And when something like a flash crash happens, who do you blame? The programmer? The firm? The exchange? The lines of who's responsible get really, really blurry. Which brings us to today. We didn't just replace the humans on the trading floor with machines. We ended up creating something else entirely, a weird hybrid of the two, a completely new kind of financial ecosystem. I love this term someone came up with for it, cyborg finance. It's a world where human strategies are executed by machines with inhuman reflexes. The algorithms are the muscle, operating at speeds we literally can't comprehend. And the humans? We're kind of like the ghost in the machine, trying to set the strategy and hoping we can keep up. It's an incredibly powerful combination, but it's also made our markets way more complex and, honestly, a lot more dangerous. So let's bring this all together. What should you take away from all this? First, trading went from being a physical, person-to-person thing to a digital, automated process. The main driver was using code to be more efficient than humans ever could be. This led to high-frequency trading, which is now the dominant force in the market, operating at speeds that are just impossible for us to match. And while this new system has some real benefits, like lower costs, it's also introduced brand new dangers, like flash crashes, that we're all still trying to get a handle on. Which really leaves us with one final big question to think about. We started this journey trying to build a better, more efficient market, and we ended up creating one that operates faster than human thought. So I want to ask you, in the grand scheme of things, do you think that incredible speed is a feature of a better system, or is it a fundamental bug? Let me know what you think down in the comments. I'm really curious to hear your take.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
You know, on Wall Street, there's this one tool. It's like a financial superpower. It can make you incredibly wealthy, faster than you can even imagine. But, and this is a big but, it can also wipe you out in the blink of an eye. We're talking about margin.
So let's start with this quote from FDR back in 1934. He said, "Naked speculation has been made far too alluring and far too easy." Now you gotta understand, he wasn't just giving some philosophical speech, he was looking out over the wreckage of the American economy. The country was in ruins, and it was all because of this financial gamble that he called naked speculation. And to really get how things went so wrong, we have to understand the tool that was right at the heart of it all.
So, what is it about this tool that's so powerful? It all boils down to one really tempting idea: leverage. It's the promise that, hey, you can control something huge, a massive asset, with just a tiny little piece of your own money.
The official name for this is buying on margin. And look, all it really means is you're borrowing money from your broker to buy stocks. The crazy part, you use those very same stocks as the collateral for the loan. Let's make it super simple. Imagine you want to buy $1 million building, right? But you've only got 100 grand. No problem. A bank steps in, lends you the other 900,000. And just like that, boom, you control $1 million asset. That is leverage.
In this slide, man, it just lays it all out perfectly. It's the brutal, beautiful symmetry of margin. Let's go back to our building. If that building's value goes up by just 10%, your personal profit on your 100 grand, it doesn't go up 10%. It doubles. Insane, right? But, and this is the really dangerous part, if that building's value drops by just 10%, your entire investment, gone, wiped out, poof. Margin is a magnifier, and it doesn't care which way the market is going. It makes your gains huge, but it makes your losses just as devastating.
Okay, so today, thankfully the game has some rules. After all this chaos that we're going to talk about, a rule called Regulation T was created. And what it says is that you, the investor, have to put down at least 50% of the purchase price yourself. That's a massive safety net compared to how things used to be. And as you're about to see, there is a very good reason for that rule. All right, so if the risks are that high, it makes you wonder, right? Why on earth do people get so swept up in these speculative frenzies? Well, this gets us into the really fascinating part, the psychology of a bubble, and this strange belief in something called the greater fool. I mean, seriously, just think about it for a second. Why would anyone in their right mind, knowingly pay way too much for something? It just seems completely illogical, doesn't it? Well, it's not illogical if you believe in what's called the greater fool theory. This is the whole idea that, yeah, I know this thing is overvalued, but I can still make a profit because I'm going to find someone else, an even greater fool, to buy it from me for an even higher price. It's basically a giant game of financial hot potato, and the only rule is don't be the one left holding it when the music stops. And listen, this is not some new 21st century thing. Oh no, this exact pattern has played out over and over again throughout history. We're talking about the Dutch tulip mania way back in the 1600s, real estate bubbles, crazy fine art auctions, and yeah, you've seen it in our lifetime with things like cryptocurrencies. The assets are always different, but the human psychology behind it, it's exactly the same. So now we've got all the ingredients for a disaster, right? We've got super easy leverage and a market just jam-packed with people who are convinced that they can't lose. And this toxic cocktail all came to a head in the single most infamous financial disaster in American history, the crash of '29. This, my friends, was the ultimate margin call.
You see, the Roaring '20s was basically one giant party fueled by speculation. I mean, some margin requirements were as low as 10%. Think about that. You could control $10 of stock for every $1 you actually had. But by the middle of 1929, the big banks started to get a little nervous. They tightened up the requirements, and then in October, the market started to slide.
That's when the Great Margin Call began, and it kicked off a crash that led straight into the Great Depression. And this chart, wow, this really shows you just how insane the scale of the problem was. Back in the late 1920s, the amount of money people had borrowed on margin made up a whopping 10% of the entire stock market's value. Now, to put that in perspective, today, that number is usually around 1.5%. The whole market was basically a house of cards built on a mountain of borrowed cash, and the foundation was about to crumble.
So what is a margin call exactly? Let me tell you, it is the most terrifying phone call or message an investor can get. It's your broker saying, hey, your stocks have tanked and you don't have enough collateral anymore. You need to deposit more money right now or we are going to start selling your stuff to cover your loan.
And that demand, that one demand, it creates this absolutely catastrophic chain reaction. Because when thousands of people get that margin call at the same time and they can't pay up, the brokers have no choice. They are forced to sell those stocks. But all that selling pushes the entire market down even further, which triggers even more margin calls, which forces even more selling. You see where this is going? It's a death spiral. The system itself just feeds the collapse.
The crash was, it was a national trauma. But sometimes out of the worst disasters comes the most important change. And that's what happened here. This was the moment where America completely rethought how the market should work. This is when the modern rules of the game were written. And President Roosevelt, he just perfectly captured how the whole country was feeling. After all that devastation, nobody wanted some weak, half-hearted solution. They demanded real, lasting reform with, as he said, teeth in it. And those teeth came in the form of 3 huge changes that are still the foundation of our financial system today. Number 1, they created a federal watchdog, the Securities and Exchange Commission. You know it as the SEC. Number 2, for the very first time, margin lending was put under federal control. And number 3, a whole new book of rules was written specifically to protect everyday investors from fraud and manipulation. Just look at the raw numbers here. It shows you just how big of a deal this was. Before the crash, you could get in on a stock with as little as 10% of your own cash. After Regulation T was put into place, that number shot up to 50%. That is a world of difference. The Wild West days of crazy, unchecked leverage, they were officially over.
Which brings us right back to today. The crash of '29 was this incredibly painful lesson about the dangers of too much leverage. And yeah, we put a lot of rules in place to stop it from ever happening again. But, markets change. New ways to borrow, new forms of leverage, they pop up all the time. And it really makes you ask the question, have we truly learned the lessons of 1929? Let me know what you think down in the comments. And hey, if you got some value out of this explainer, a like and a subscribe would be amazing. Thanks for watching.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.